Hi friends and welcome back. Most people think investing into the markets is about picking the right stock or about buying a crypto coin that your best friends told you about. But the truth is, the real goal of investing is not to take care about what you invest in, but it's really a matter of how you allocate your capital. In other words, how you spread your money across different investment classes. In this video, I'm going to break down why asset allocation is one of the most important decisions you are making as an investor, what diversification really means, and I will even show you my own asset allocation. Before we dive in, make sure to subscribe to the YouTube channel, leave a like, and comment your asset allocation. Thanks for that, and now let's dive in. Why you should invest at all. Let's start with the basics. If you are not investing, you are falling behind. Why? Because inflation silently eats away all your money you've saved up. Imagine, the inflation is at 3% and your savings account pays you 1% interest. That gives you 2% less value each and every year just by doing nothing. The first principle is simple. You must invest. That's not optional if you want to grow your wealth and be financially stable. Why diversification matters? Okay, you're investing, but in what? This is where diversification comes into place. Diversification means spreading your money across different types of assets so you don't rely just on one bet. There's an old saying that you should not put all your eggs in one basket. While this sounds like a cliche, it's actually backed up by data. Ray Dalio, the founder of Bridgewater, often talks about a dream portfolio where investing into different stocks that are not correlated. These uncorrelated assets mean when one goes up, the others might go down. And one goes down, the others might go up. They're not dependent on each other. That way, you are reducing risk while still holding the foundations for a long-term return. Diversification is what keeps your portfolio alive during downturns. It's the reason why some people get scared and are not sleeping well while they're in a recession, and others are sleeping well and get better returns just because they have balanced their risks over different assets. My personal allocation. Let's get to my asset allocation. This is not a financial advice. This is just how I invest my money into the markets. I keep it simple. Exempt from real estate or collectibles, I invest myself like this. I allocate 80% of my money into equities, such as stocks and ETFs. Another 10% goes towards bonds, especially into ETFs that are filled with state and company bonds. And number 3, I have 10% into crypto assets, especially Ethereum, Bitcoin, so the general basic ones. And now I will explain you why and how I invest into these allocations. 80% equities. The bulk of my money is into equities because historically stocks have been the single greatest wealth building tool of them all to each and everyday investors. Over the past 100 years, the S&P 500 returned about 10% per year on average. Yes, this is fragile, there are crashes, and it's volatile, but actually it's great to grow your wealth. Inside equities, I like to switch it up. I like to invest into ETFs on broad exposure such as the S&P 500 or the MSCI World. And on the other side, I like dividend paying stocks because I love the cash flow. Companies such as Realty Income are just perfect for that because they pay dividends on a monthly basis. And this is exceptionally perfect for someone who prefers to get a steady income. But of course, sometimes I play. I like to go into leveraged ETFs, such as the called Holy Grail, the Amumbo, who is an S&P 500 2x leveraged or an MSCI World 2x leveraged ETF. I myself am really comfortable with volatility, but some people might are more risk averse and should not invest in such kind of leveraged ETFs. I like it, I do it. 10% bonds. Next, I put about 10% of my invested capital into bonds, especially via ETFs. One of my most favorite ETFs in bonds is the JP Morgan Emerging Markets ETF bond, which pays out on a monthly basis regularly with a really high interest and gives me the same benefits as dividend stocks with a free cash flow. I don't overload on bonds because I'm still young, but that 10% gives me a stable and steady income instead of too much of volatility. But for people who might need the money even earlier than me, they might should add up the percentage on bonds. 10% crypto. And finally, I'm investing 10% into cryptocurrencies. And let me be clear here. I'm just investing into Bitcoin and Ethereum. That's it. I see crypto as a high risk and high reward asset. It's something that could be kind of declared as digital gold, such as the Bitcoin, or a utilized coin such as the Ethereum, but it's actually really risky and might lose your capital. To me, it's a bet on decentralized finance, nothing else. And I'm not investing into meme stocks or different speculative coins with a low market value just because I'm not too much into these coins. I'm not investing in things that I don't know or understand. And I'm trying to be as defensive as I must be, but also as risk likely than I have to be to get rich returns. And you might have noticed that I've missed gold on this list because a lot of people put 5 to 10% into gold, but I don't do this because I don't see gold as a production for cash flow. I see this more as a holder of value. I know the gold price is at the really top, but I think it's not something that is productive in making real money. That's the same with cryptos, but there are some other factors I would consider in cryptos where I'm invested in. For me, gold is just not productive capital, so I don't invest into it. Why this works for me? This mix gives me growth from equities, stability from bonds, and upside potential from crypto. It's simple, it's easy to manage, and most importantly, it keeps me invested into the market over a long term without constantly panicking about volatility or changing their assets. Because here's one truth you should really know. The perfect and the best portfolio isn't the one with the best asset allocation or how it looks on paper. It's the one that can actually stick to your goals, to your risk profile, and it's as easy as possible. It's about good returns and a slow but steady growth. Takeaway for you. What can you learn from this? First, always invest. Inflation is eating up your wealth. Number two, diversify. Don't rely just on one asset or asset class, but diversify into different classes, stocks, ETFs, or other assets. And number 3, find the allocation that suits your risk profile and the way you want to live, and a good sleep. Whether you want 60-40, 70-30, or 90-10, it's about you. It's about you having a plan and sticking as long as possible to it to compound interest over as long time as possible. This is my approach on asset allocation, investing, risk profiles, and asset itself. Tell me in the comment what's your risk profile, risk averse or risk seeker? Which asset allocation are you for? 90-10, 20-80, or something completely different? Tell me and how you invest. Thank you for watching. Subscribe to the channel so you don't miss out on other videos about investing, personal finance, AI, startups, and so much more. Thanks for that, and see you in the next one. Cheers.